Welcome back. This is episode 141. As you've probably been reading over the news in the past few weeks, the second largest bank collapse in U.S. history occurred in California. It's a bank known as Silicon Valley Bank, SVB. And shortly after that, another bank based in New York City known as Signature Bank also collapsed, making that the third largest collapse. And unfortunately, there's speculation that another bank, I'm recording this on March 15th, Credit Suisse may also be on the brink of collapse. So in this week's episode, I want to talk about what happened, what a bank collapse is, how you can protect your money from being lost due to a bank collapse, and what this collapses could mean to your retirement funds. But before I jump into that, I just want to remind you that my in-person retirement readiness workshops are taking place right now. And if you want to simplify planning for your retirement, if you want to figure out some of the best ways to save for retirement, how to manage your spending in retirement, and much more, consider signing up for one of my in-person classes. If you head over to retirewithryan.com, and then in the navigation, click on courses, you can be taken to a page which shows you what the remaining classes are. I will also be launching my on-demand course. That'll be going up in the next few weeks, and that'll be another option for you if you don't live local to where I am, or if you just want to study at your own pace, you can consider signing up for that too. So let's get into what happened. So who is Silicon Valley Bank, SVB for short, as I mentioned? If you're like me, you probably never heard of them before. And they're apparently a bank that is located in California that predominantly served technology companies and venture capital funds. And from what I understand and what I've read, this is rather unique banking because it's hard for these companies to borrow money. So they had a bit of a niche, and it led to rapid growth. They had about $60 million in total deposits, $60 billion in total deposits in the first quarter of 2020. But that was 2 years later, in Q1 of 2022, $200 billion. So obviously, that's some crazy growth for a bank. It's not normal. And what do banks do with money? Well, they invest it. And in this case, they invested it into U.S. government savings bonds, safe investments that they bought into. Well, unfortunately, what I've been talking about is that the Federal Reserve has been raising interest rates. So that means anytime you buy a bond and interest rates are going up, the value of your bond is going down. Now, if you buy something like a U.S. Treasury and you're going to hold that until it matures, there's no problem. You're going to get back the original $1,000 that you invested plus your interest. But if you have to sell that in the meantime, and we've had the historic, meteoric rises in interest rates that we've had, then your bond could be worth significantly less than what you paid for it. So that's what was happening with SVB, and some of their investors were now starting to demand their money. A lot of these tech companies that they lend to, unfortunately, were struggling. So from what I understand, they were burning through cash. They were requesting some of their cash back, and it caused the bank to then, SVB, to have to sell a lot of these treasuries at major losses. And, as a bank, they have to keep a certain amount of cash on hand. So what they decided to do was sell more stock in the bank itself. And that then triggered people to really question the bank's stability, caused the stock to crash. And a lot of the funds that invest in them, a lot of the venture funds, then recommended to their clients that you should probably pull your money out of this bank. So all of a sudden, within 48 hours, because this all started on Wednesday, March 8th. So by Friday, March 10th, the bank had collapsed, and the FDIC had taken over. The regulators had stepped in, and the California regulator estimated that there was a request of $42 billion of money requested from SVB in that time frame. Now, you've probably been seeing other stories that companies weren't able to make payroll. A lot of these clients are not your typical, mom and pop investors. They are businesses that were keeping their business banking accounts there, and all of a sudden now some of these companies couldn't even make payroll. So obviously this could be very devastating. So the regulators have stepped in. the Federal Reserve, Treasury, and FDIC announced that all depositors would have full access to their money starting on Monday, March 13th. So that's a really good thing, because what that means is that even if you had more money invested than was above the FDIC limits, which I'll get to, you're being made whole. But shortly after then, another bank, Signature Bank, also saw a run on its deposits. And to prevent another collapse, regulators also seized Signature Bank. So we had 2 bank defaults in the course of a few days. Really something that we don't see all the time. And there's other small banks that are seeing some of their stock prices go down significantly. As I mentioned at the beginning of the show, there was a major downgrade to Credit Suisse Bank. So we'll have to see. Hopefully that also doesn't default. So let's talk next about what is a bank collapse. Well, a bank collapse is when the bank can't meet the demands of its depositors. And from what I understand, it usually takes more than 48 hours for a bank to completely collapse. But thanks to the internet, thanks to the speed of information now, and also thanks to how quickly we can transfer money on our phones, it could maybe happen a lot faster than it's happened in the past. You don't have to go down to the bank like before and request your money. All that needs to happen is the public to believe that the bank is not safe. People start requesting their money, start transferring their funds out, and eventually the bank will hit a point where it can't meet the demands of all the withdrawals that are being requested, as happened with SVB. So that's how, banks don't operate. Banks operate by not keeping all of your deposits on hand. There's a minimum amount of deposit that the Federal Reserve requires banks to have, and then banks lend out the rest of your money. That's how they make money. It's called, they make money on the spread. They lend out your money at a certain rate of interest. Between that rate of interest and the fees that they collect, minus what they have to pay for their operating expenses, and they paid interest to depositors, is how they make a profit. So that's how they work, and the problem comes if people think the bank isn't stable and all of a sudden they start requesting their money out. And if you've seen, the movie It's a Wonderful Life, right? We just went past Christmas. George Bailey with his bank, right? That's what happened there. Investors came in, wanted their money. He actually had enough money, I think, from his wedding where he could pay the depositors and stay in business with like $1 or $2. But that's not real life. And in this case, SVB couldn't meet the demands, so the Fed had to step in. So it's hard to predict a bank default. It'd be nice if you could predict this, but these things happen very quickly. One indicator is you could look at the credit rating of the bank. If a bank has a really low credit rating, then maybe you don't want to do business there because of the fact that there could be a default. And to give you some context, banks don't fail every year. In 2021 and 2022, there were no bank defaults. So far this year, there's only been 2. We'll see if there are more. There were 4 in 2020 and 2019. And you really have to go back to 2009 and 2010 to really see significant bank defaults. In 2009, there were 140, and in 2010, there were 157. So we were coming out of the financial crisis. So you'd expect to have a lot more bank defaults. I think Washington Mutual was one of the biggest bank defaults back then. So number 3, what can you do to protect yourself? Well, the FDIC has said that all depositors will be made whole with these 2 recent bank failures, including people that had over the FDIC limit. And according to one article I read, 94% of SVB depositors exceeded the FDIC limit. So it really would be catastrophic to our banking system if the regulators said, we're only going to cover up to the FDIC limit in this instance, and all of a sudden people had lost a lot of money, and maybe this create more runs on banks. And this is obviously not what our banking system wants, not what our government wants. So the government wants to keep people calm. They want to keep people from pulling all their money out of banks because, as I said before, banks don't have all the money there. So just remind yourself of what the FDIC limit is. It's $250,000 per depositor per bank. So that if you have a joint account with your spouse at a bank, you can have up to $500,000 of FDIC insurance. And some banks and brokerage firms actually offer you more insurance above those amounts. You would just want to check with your bank and your brokerage firm. So if you are someone who keeps large amounts of money with your bank in either CDs or savings accounts, then you should really check this FDIC limit, and you should make sure that you're not over it. And if you are over it, think about moving your money to, one option would be to another bank, because we just don't know if the government is going to continue backstopping people above and beyond the FDIC limit. They've kind of set a precedent here, but doesn't mean that if we get in a really bad situation, that you could lose money by being over the FDIC limit. So another option is that you can diversify out of bank products, out of CDs, out of savings accounts. What's another option? Well, you could use U.S. Treasuries. U.S. Treasuries are backed by the full faith of the U.S. government. A lot of people argue that the U.S. Treasury is safer than banks and FDIC. So as long as you don't think the U.S. government's going out of business, you could buy U.S. Treasuries. A side benefit of that, which I've mentioned in other episodes, is that the interest you receive on U.S. Treasuries is exempt from state income tax, so that, as compared to CDs and typical bank savings accounts, you're paying, if there is state tax where you live, you're going to pay state tax on that. So that's a side benefit. And then you could also consider money markets. There are a lot of money markets out there that are backed by U.S. government bonds. They're very safe as well. And, none of these things are guaranteed, right? U.S. government could collapse at some point, hopefully never in our lifetimes or in our children's lifetimes, but it could happen. But until that happens, the U.S. government's going to be pretty safe option. So what does this mean, lastly, for your retirement funds? Well, it depends how you have your funds invested. If you have your retirement funds in mutual funds, in stocks, in ETFs, in bonds, there really should be no impact over the long term. The collapse of a bank really shouldn't impact these investments. However, in the short term, there could be more volatility in the markets, because we've seen in the days following this collapse that there's been more volatility, because the big concern is, what does this mean for other banks, right? For the banking sector? A lot of other bank stocks, even quality banks, are down 15, 20, 25%. So, if you're a bit of a speculator, there could be some opportunity there, especially if these banks stay in business. But there's also a lot of risk, because even up into SVB collapsing, some financial analysts were recommending, SVC is a great bank, or VB is a great bank, So there is risk there. So just be careful of that. But if you do have a lot of your retirement money in CDs, other bank products, just check the FDIC insurance. Make sure you're not over the limit, because as I said before, we just don't know if the regulators are going to keep backing people up above and beyond this FDIC limit. So hope this gives you some perspective on what's going on. And this is also be a good time too, if you haven't reviewed your investment portfolio in a while, if you haven't reviewed your asset allocation, this can be a good time to do this, because I recommend doing that on an ongoing basis, but especially during times of crisis. I'm hoping that what this is signaling to the Federal Reserve is that maybe they've gotten to the point where they've raised rates enough where it's going to impact the economy, going to impact the job market, and maybe they'll back off on interest rates a little bit. And if they do, that should be positive for the stock market. But irregardless, you should always be reviewing your asset allocation once a year to make sure you're still comfortable with it and it still meets your goals. So as a reminder, if you have a listener question you want to have considered for a future episode, please go to retirewithryan.com to record or leave your listener question. Have a great week, and I look forward to talking to you next Wednesday. Take care.